If the stock market is doing so well, why are many companies laying people off? I'll talk about that in this video. My name is Katherine. I'm a CPA and your accounting tutor, and I help accounting majors like you through graduation and beyond. There are a lot of ways to track the health of the overall economy, and a common metric is to look at the change in stock price for the largest 500 companies in the United States, also known as the S&P 500. There's a lot of nuance around how companies are chosen and how the value of the S&P 500 is calculated. I won't be getting into all of that here. For calendar year 2023, the S&P 500 increased in value about 24%. That's unequivocally a great number, and it implies that the economy is doing great. If that were true, why are so many companies laying people off? According to layoffs.fyi, a layoffs tracker, as of the time of recording, about 1,400 companies have laid off more than 300,000 employees since January 2023. The missing piece in this equation is interest rates. Most businesses use some sort of debt to grow their business in the form of either loans or bonds, and they owe interest charges on those debts. The size of the interest rate depends a lot on the federal funds rate, which is controlled by the Federal Reserve. The federal funds rate is the interest rate that banks charge each other for short overnight loans, and since lending money to another bank is generally seen as a pretty sure thing, the rate that the rest of us get on student loans, car loans, mortgages, and business loans is higher than the federal funds rate. I'm not going to get into all the details of the Federal Reserve rate and the overnight loans banks make to each other in this video. You can read more about it in an article linked to in the description. The interest rate that banks charge each other has been increasing recently, which means that the interest rates on all other loans have also been increasing. The business model of most tech companies has been to lose money for years with low prices in order to gain market share and grow, with the idea that once they're big enough, they'll raise prices to be able to turn a profit in the future. There have been low interest rates in recent years, which has made it cheaper to borrow money, and more tech companies could stay afloat and reach for that growth. It's usually not a good business decision to ignore profit for as long as many companies have. While some of them will ultimately succeed, most will fail. While stock prices are generally an indication of the future outlook for a company, layoffs are usually a response to current conditions. Rising interest rates and the related increase in interest expense on loans are making it more difficult for companies to stay unprofitable in the hope of growth and future profit. So these many recent layoffs are happening in an attempt by tech companies to turn a profit and decrease their expenses. Additionally, many tech companies hired more people than they actually needed during the pandemic, expecting growth that never came. So laying off the employees they don't actually need can be seen as low-hanging fruit to decrease their expenses. The stock prices of companies which had layoffs in the past few years have generally increased afterwards, meaning that investors believe these layoffs will help the companies to reach or maintain profitability. Because the layoffs are being rewarded in the market with higher stock prices, more companies are incentivized to create layoffs or at least consider whether they might be warranted. This is a complicated topic. I know I didn't touch on everything I could have. Hopefully you understand it a bit better now. If the uncertainty of a layoff makes you wonder about going to work for yourself, take my free quiz linked in the description about whether you should consider being self-employed or working as an employee. I'll see you in the next video. Bye!